Hello, clients, friends, and colleagues. This is Rich Siegel with ARQ Wealth Advisors, and today is Sunday, August 16th. I hope everyone's doing well. Just wanted to give a quick update on the economy and the markets. It's been a few weeks, and there's some interesting things to go over. This is going to be focusing on all the positive things that are going on today. We all know what the negatives are, so let's jump right into it. Okay, so I have a chart up here with various economic data points. And the first data point is the unemployment rate, currently sitting at 10.2%. Okay, so although millions of people are out of work, the forecast was for upwards of 20%, and we're about half of that right now. So things have improved. It will probably take a few years to get back down to the 4% range, but this is definitely a move in the right direction. On top of that, it does look like with Trump's executive action, hopefully they'll be able to roll out some type of assistance for people that are unemployed above and beyond the regular state benefits. And then hopefully Congress will get their act together and solidify that. Manufacturing has seen a huge recovery. Anything over a 50 is considered expansion of the manufacturing sector. 54 is quite a number, so that is quite a nice metric for the economy. Manufacturing makes up about 13% of our GDP in this country. Retail sales, they cratered, and then they've come right back. Obviously, there's some beneficiaries of this, specifically like Amazon, for example, will be a big winner. But retail sales have come all the way back to trend. And a lot of that has to do with autos, and the housing market has been incredibly strong over the last few months. Speaking of housing starts with interest rates under 3 for a 30-year mortgage, and with a lot of folks stuck at home, not traveling, not going out to eat, they're spending money on housing. And the housing market for housing starts has rebounded significantly. So these are all great data points to consider. This is the 10 to 2 year spread between 2-year treasuries and 10-year treasuries. When these lines are touching or overlapping, this is an inverted yield curve, which signals a recession. That did happen. And now it's widening out. This is a good sign. This shows that the economy is starting to become healthier. So a widening or steeper yield curve is what you want to see after a trough in the economic metrics. Okay. Moving on to the markets, the VIX, as we've discussed many times before, is the implied volatility or fear indicator, fear gauge. We had extreme fear and extreme volatility, record high here in March at the bottom of the market, March 23rd. And as the markets come back, the VIX has come down. Right now we're sitting in the low 20s. Historically, the VIX sits at about 18. So a VIX at 10 or 12 implies very complacent, very low volatility. A VIX above 30, 40, 50, and we hit 84 in March, implies extreme fear, extreme volatility. So this is a good sign. Over here, I thought this was quite interesting. For the last week, we've seen a nice rotation, broader participation in the markets. Most of the winners have really been in the infotech and communication services space over the past few months. Think of Apple, Amazon, Facebook, Google, Microsoft, huge winners. What we're starting to see now is fits and starts of economically sensitive sectors beginning to outperform. Last week is a great example where these were towards the bottom of performance, and the top performers were the economically sensitive sectors, which, by the way, when you come out of recession, tend to be the leaders anyway. There's unprecedented monetary stimulus out there right now. And as that happened, the dollar got weak. And as the dollar got weak, what you see here is that the top performing asset class in the past few months has been the emerging markets sector, up 18.5%. Emerging markets would be most broadly defined as China, Taiwan, Brazil, Mexico, Russia, a lot of Asia. The second best performing area, not surprising, is the Russell 2000. These are small cap stocks. A lot of energy, a lot of financials. That's 13.5. And then picking up the rear here, again, great returns. S&P 500 is the green and the Dow Jones is the blue. So to wrap this up, a few bullet points to consider moving forward. Believe it or not, the recession of the coronavirus recession is most likely over right now. Okay. We troughed in April or May. We're beginning to rebound right now. This would be probably one of the shortest recessions in our country's history. Okay. The GDP forecast on an annualized basis for the third quarter is around 15% positive. That's annualized. It was negative 32.9%. It was negative 32.9% for Q2. So this is the start of a nice rebound. This is a great time to be ultra diversified. And by that, I mean not only in US stocks, large cap, mid cap, small cap, value sectors like energy and industrials and financials, as well as the technology and healthcare, for example, but also to have money overseas, Europe, Japan, Canada, Australia, and then Asia specifically. A lot of these countries are out of recession. Their coronavirus cases are lower than ours. Their mortality rate is lower than ours. And they seem to have handled the recovery faster than we have. So, and with a weak dollar, that would put a tailwind behind those markets as well. Okay. As far as the broad market goes in the US, if you look at the S&P 500, I would say that stocks are a little bit expensive relative to history. But if you remove those big winners, those Fab 5 stocks like we've spoken about, the rest of the market is trading in the high teens as far as price to earnings ratio, which would be a fair value based on where interest rates and inflation is today. So there are expensive parts of the market, there are fair valued parts of the market, and there are cheap parts of the market. Broadly speaking, overseas markets are cheaper than US stocks today. Okay. As we head into the election season, we do expect increased volatility. That's typical. The VIX tends to spike 20 or 30% during the few months leading up to the election. Also, summer months tend to be more thinly traded, more volatile. Okay. Our portfolios are positioned quite well in bonds, alternatives, and stocks around the world. So with that, have a great day. I hope you enjoyed the video, and we'll see you soon.